the market is pricing in around 75 basis points of cuts for the remainder of the year. The median dot plot is at 50 basis points, and a large minority within the FOMC sees 25 basis points as most likely. So, in short, that is why we see more room for dissent going into the last two decisions of the year, more volatility surrounding the big macro events, and of course, more policy uncertainty as well.
This is Converge, a podcast from Convera. Come with us as we shape the future of finance.
Welcome back to another Converge Market Update. It's September 25th, 2024. I have both Boris Kovacevic and George Vessey with me. Thanks, guys, for joining. So, surprise 50 basis point rate cut has jump-started the Fed's easing cycle. Markets have taken it well and are pricing in the possibility of another jumbo cut in November. Boris, give us the reasoning behind going big now instead of starting slow, if you can. And was the market reaction the one you actually expected?
Yeah, so I think the most important takeaway from the decision itself has really been the shift in risk management from the Fed, I would say. So the weakening of the labor market has clearly caught the FOMC's attention here and has really replaced inflation as the main determinant of future monetary policy, which I think is how the large cut was actually justified in the end. And this has given investors also the green light to push for more easing, even as early as November and December. So Wall Street seems to be reading between the lines. If the Fed's willing to cut 50 now, why not again in November? Especially as the incoming macro data continues to disappoint. One thing to note here is Fed Chair Jerome Powell's importance in really pushing the large cut over the line. I think he had to convince some other members of the FOMC of the 50 basis point cut and work for the consensus, which in the end, unfortunately, he didn't get because Governor Bauman's dissent, the first one from a governor in almost 20 years, by the way, seems really like a crack in the Fed's united front. The market is pricing in around 75 basis points of cuts for the remainder of the year. The median dot plot is at 50 basis points, and a large minority within the FOMC sees 25 basis points as most likely. So, in short, that is why we see more room for dissent going into the last two decisions of the year, more volatility surrounding the big macro events, and of course, more policy uncertainty as well. But for now, as you mentioned, markets have really welcomed the large cut with open arms, as is very much evident from equities being at record highs, the dollar coming down quite a bit in response of these lower interest rates and bond yields in the US falling to the lowest level this year so far.
As you said, the Fed has given other central banks the green light to continue easing policy. The Fed has reached out its hand, so to speak, but it seems that not every central bank was willing to actually take its hand. So, George, why has the Bank of England refused the opportunity to cut rates for a second time this year, in your opinion?
Hey, Alex. Good to be back with you guys. So, ultimately, the Bank of England seems to be or is more cautious than the Fed and most other major central banks right now, and that's because of its concerns around inflation picking up again. But let's not forget that it has started its easing cycle already, a 25 basis point rate cut in August, which took the bank rate to 5%. But as you mentioned, the Monetary Policy Committee voted to keep it at that level last week. It was almost a unanimous decision, 8 out of the 9 policymakers voting to keep rates unchanged and only one for another rate cut. But this is what we expected. It's what the markets expected as well. But really what's important is the language in the statement that accompanied this decision that really makes it clear that the Bank of England isn't in a rush to lower rates at a quick pace. And that's because we haven't had any material developments in the UK to really alter that stance. We have had some moderation in UK economic growth, but activity levels are still holding up quite well, certainly on a relative basis. And also, despite the normalization in inflation expectations, as well as the easing in labour market tightness, wage growth in the UK remains above inflation target consistent levels still. And then finally, we've got the services inflation in the UK, which is what the Bank of England's most attentive to, and that's higher in the UK than in the US and the Eurozone. And at face value, it's really going in the wrong direction. So, as a result of all of this, the Bank of England is sounding more hawkish than its peers. That's why markets continue to price in less rate cuts compared to the Fed and the European Central Bank. And it's creating this divergence, or rather this more desynchronized pace of policy loosening. But having said that, we do think that the Bank of England is going to resume cutting rates in November. And we're also leaning slightly more dovish than markets right now because we think another cut is more likely than not in December as well, especially because of the prospects of tighter fiscal policy to be announced by the UK government at the UK budget at the end of October.
Nice. So it's definitely a divergence at play on both the macro and the policy front. Would you say it's as simple as mapping these regional differences onto the FX side of things to explain the recent outperformance of the pound, George? It seems like the slowing US economy has given investors the first impetus to sell the greenback, but how much other currencies appreciate it seems to depend on the regional outlooks. Would you say that's about right?
Yeah, I'd say so, Alex, because as you say, the dollar has suffered intensified selling pressure over the last few months. The dollar index has fallen 5% since early summer to its lowest level since July 2023, just this week. But there are regional differences for sure that we need to be aware of. The Japanese yen, for example, that's appreciated over 11% this quarter, making up the bulk of the dollar's losses. That's due to the carry trade unwind as a result of diverging monetary policy between the Fed and the Bank of Japan, as we've spoken about previously on these podcasts. But if you compare the euro and the pound, for example, the euro's only risen around 1% against the dollar this year, whilst the pound has risen over 5%. And this is really because of the relative outperformance in UK economic data versus the Eurozone at a time when expected growth differentials are really driving G10 currencies. And then the knock-on effect of this is of course what I mentioned earlier, with the Bank of England not expected to cut interest rates as fast or as much as the European Central Bank. So this also increases the pound's relative yield appeal. So we've got growth and yield differentials playing into the pound's hands right now, and that's why we've seen sterling better placed to absorb the recent dollar weakness. And in fact, the sterling dollar exchange rate reached 134 this week, and the sterling euro exchange rate popped above 120, both above 2-year highs. But we've got to bear in mind that the pound is also a pro-cyclical currency as well. It's got a high beta to risk, meaning that it's sensitive to changes in global risk appetite. So with the recent developments that we've had, the positive ones in terms of the global easing cycle picking up some pace, and even China's stimulus measures that were announced this week that have helped lift equities to all-time highs, as Boris mentioned. This is another bullish driver for the pound recently, and one that could continue and drive it higher in the future.
Interesting. So hearing George talk about the UK, it does paint a contrasting picture to the US, but even more so to Europe. We've been talking about the pessimistic news flow on that continent, and it doesn't seem to get much better, does it, Boris? What seems to be the problem?
Yeah, so the last couple of years have, I would say, really laid out the structural problems that some of the larger European economies have right now. And of course, they are being made worse by the cyclical downtrend of the manufacturing, but also the real estate sectors. So just to focus on Germany for a second, as we have in the last couple of episodes, the German economy is really stuck in a stagnation spiral. Growth prospects remain subdued. There is a lot of pessimism surrounding the overall structure of the economy, and think tanks continue to revise down their forecasts for this, but also for the next year, due to the ongoing continued negative news flow and the incoming macro disappointments. And I think this week so far speaks really to this overall trend, because we had both the purchasing manager index for the manufacturing sector, but also the highly important IFO business climate coming in much weaker than expected. And both are near their lowest levels outside of any recession period. I think what is striking here is not only the extent of this weakness, but also the duration. Business confidence has been below trend for 25 months now. And if this route continues for 2 months, it would actually surpass the duration of below mean confidence seen during the global financial crisis between 2008 and 2010. So it's clear that something needs to change to induce this turnaround of the economy. But the problem here is that we have a really complicated political landscape domestically in Germany, but also in Europe as a whole, that makes change really difficult to implement right now. And now, of course, it would suggest that these structural factors, this weak macroeconomic outlook, would bode well for the US dollar versus the euro. But the euro dollar exchange rate is actually up on the year, as George mentioned. And this is mainly a function of a weaker dollar and not so much about, again, Europe outperforming, which is definitely not the case right now.
Yeah, so a somewhat dire outlook for Europe, but the euro is sort of kept up by the dollar's weakness, it sounds like. If we stay on FX markets, the US election is around 6 weeks away. Anticipation is building, of course. George, give us an outline of how the US election could impact FX markets.
Yeah, sure, Alex. It is a tricky one, to be honest, though. I'll try and simplify our thinking as much as possible. I think, firstly, it's clear that the US dollar favours a Trump win, reflected by the dollar's reaction to betting markets when the odds of the Democrats winning have risen, the dollar has weakened, and vice versa. So we think in the short term, the best case scenario for the US dollar would be a Republican clean sweep, meaning they control both the Senate and the House. And this is because of three key policy consequences that come with this. Firstly, domestic policy under Trump, that would be looser fiscal measures such as tax cuts, and that raises US growth prospects, and that could reignite this whole US exceptionalism narrative that supported the US dollar strength over the last couple of years. Second, we've got trade policy, higher tariffs on China, other protectionist measures that boosted the dollar back in 2018 and 19, especially against riskier currencies, and that's due to the dollar's safe haven appeal in this scenario. And thirdly, arguably the most important, is what all this might mean for monetary policy for the Fed, because protectionism, tax cuts means that expectations for the Fed's terminal rate are probably going to rise. So slower and smaller rate cuts by the Fed than what markets are pricing in at the moment should again lead to a stronger dollar. And then on the flip side, of course, if Kamala Harris prevails, then Democrat fiscal consolidation, the pricing out of tariff risks, that should support expectations of an orderly Fed easing cycle and therefore a weaker US dollar. But we also know that there are many idiosyncratic factors affecting other currencies to be wary of, like how low yielders such as the Japanese yen and Swiss franc are probably going to be more sensitive to the rate story, pro-cyclicals like the pound and the Norwegian krone and the Swedish krone being more sensitive to geopolitical risks. We've got commodity currencies like Canadian dollar, Aussie and Kiwi dollars more sensitive to trade risks. So there are many complexities when it comes to analysing the impact of the election on FX markets. But we have produced an election guide, and that's going to help explain all of this in a bit more detail, and that's going to be available on the Convera website next week.
Yeah, that's exciting. We'll definitely point listeners to that in the show notes. Please check it out. It should be a great amount of detail around what we expect with this impending election cycle being so consequential. So lastly, Boris, China is as hotly debated when it comes to the presidential election as U.S. domestic policy, it seems. So China has, of course, underperformed expectations like Europe this year, but it seems policymakers are finally hearing the ever-growing voices for more stimulus. Boris, walk us through the big news this week, and do you think it will matter?
Yeah, big news indeed, Alex. So much so that the Chinese equity benchmark, the CSI 300, recorded its biggest daily gain in more than 4 years following the news on Tuesday. And I think it basically boils down to more stimulus measures being announced, basically to safeguard the economy from the current downtrend. So the central bank unveiled the biggest stimulus package since the pandemic. And this was kind of in hope of what investors think is Beijing finally understanding the seriousness of the domestic slowdown and the property market. So what has been done specifically? They cut the interest rates on existing mortgages by 0.5%. The policy rate was lowered by 20 basis points as well. And then I think the most consequential measure was to reduce the deposit to buy a new home from 25% to 15% of the home's value. And this is a step, I think, in the right direction, because according to the PboC governor, this will inject about 140 billion of US dollars of liquidity into the market on a longer term basis. But it also reduces the household's interest bill by around $18 billion a year. And I think it was criticized by some economists because what most investors expected as the next move was kind of a bazooka of stimulus coming our way. And it doesn't seem that way. I think while they are consequential measures, it's not like the PboC and fiscal policy are going all out. And I think this could be a problem because these measures that have been announced so far are not really enough to put us on a growth path that we are used to from China over the last couple of years before the pandemic. So it will be interesting to see if the move higher in equity sticks. But so far, both equities, as I said, I think up 8% this week so far, but also the Chinese one, they are benefiting from these prospects of more monetary policy and more fiscal stimulus coming our way. And I think this is the important news of the week so far.
Okay, well, we covered a lot. Thank you both. Good to check in, and we'll see where things sit in a couple weeks. Appreciate it, guys.
Thanks, Alice. Always a pleasure.
Cheers, Alex.
Cheers.